Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. As well, I am a loan officer, senior director at Old Capital Lending, and we are a premier provider of debt. We are real specialists in multifamily, but we'll do the other asset classes. So if you're looking at a deal, especially in multifamily, I can give you an indication, okay, where that proceeds are going to come when you get this under contract based on the financials. So I'm going to need your T12, a rent roll, an OM, offering memorandum, and your underwriting. Now, remember, when you get into this deal, you're going to get all those financials. You're going to start inputting them into the underwriting model. I would recommend look up the 10-year treasury. Today it was 425. I don't know what it ended up, but 425. And then I would add 250, 2.5. So if you take 425 plus 250, you're at 675. That's where I would be underwriting these deals. And I'd be underwriting them at 65 to 70%. Don't go to 75 and don't go to 80. Really come in conservative, all right? Put those numbers in, take the T12 and put in the expenses, and then pick up the phone and call or email JT Lynch. He's here tonight. We're going to hear from him. And then pick up the phone and call your taxing authority, the assessor's office. See how these taxes are assessed upon sale. Some are going to be using the purchase price and it'll have maybe 100% or 85%. Or maybe they're not assessed upon sale. Maybe it's every 4 years. So that's going to be important when we're underwriting. And then the third one is get your property manager on the phone. Go through your assumptions. Where do you think payroll needs to be? G&A, R&M. Pull out any R&M CapEx that exists in the T12. All right. Then before you put in an LOI, I want to see all of those things: T12, rent roll, OM, and underwriting. And I'll give you in 48 hours, I will give you this indication. And now you can say, does this make sense? Should I put in an LOI? Don't go into this empty-handed. There's too many ways that people are, having you get into a deal and then you cannot execute. Okay, so be positive and be able to get this under control immediately. So I want you to meet Kenneth. Kenneth is a real estate maestro. He is living out his dream. He decided to crack the real estate market starting with single family homes back in 2012. And since then, he has upgraded to playing in the big leagues, the larger multifamily properties. In 2017, he made a leap to investing passively in multifamily, because why stop at passive investing when you can run the show with a portfolio? So fast forward a couple years and Kenneth has orchestrated his first deal. He then got in as a lead sponsor. Now he's a proud captain of 3 properties worth tens of millions of dollars, a totaling 368 units and an additional 1,000 plus units passively. And it's like juggling real estate properties is his superpower. Before diving into the world of property conquests, Kenneth spent 17 years as a computer network engineer, and for 11 of those years, he ran a small data consulting business. He's a Texas A&M business school, and they would be very proud of him as an alumni. Now he's traded his tech cape for the real estate cape, and Kenneth is now a full-time asset manager, investor, and real estate coach. He doesn't just make deals, he makes dreams come true in square footage and ROI. He's a regular here at Zoom at 8 since 2020, and this is our own Kenneth Sumners. Welcome back. Welcome to Zoom at 8. So glad you're here.
Thank you. Appreciate it.
And, I just love the success, and I want people to be dreaming. And that's why I brought you in, because you have started like so many of us in single family, then went passively, then went into owning our own general partnership. So we got to cover a lot. But I do want to know, how are you finding things today, Kenneth? How are you have retired from your day job. Let's talk about the family first, and then we'll get all into the details. How
Sure.
how are you finding life as a full-time investor in quite a challenging market and having two little kids?
That's right. I've got two young kids. One's 6, one's turning 4 in 2 weeks. So uh, I started this real estate thing about the same time that we had our second kid. So it's just, you know, every time I make a big life change, I seem to be making 3 or 4 life changes all at the same time. So might as well just, do it all, have some fun. That's what life is about, right?
Wow, it's fantastic. So, if everybody would do me the favor, go to the right-hand side of the screen, and there are 9 dots. If you would click on that and go to the speaker view, and then we can give all of our attention to Kenneth. He's the guy who's going to be, once he speaks, he'll be on your screen. So, all right. So you have quit your job. You have two little daughters. And by the way, I remember when the littlest one was born, and it didn't stop you, quite frankly.
Right.
Do you come from a family of entrepreneurs who have done real estate? Kind of walk us through where you started. How did you get inspired?
So yeah, I do come from a pretty good line of entrepreneurs. I think 4, maybe 5 generations of entrepreneurs. Um, it's not all been in real estate. Everything from like a general store on the wide part of the road in southern Texas to my grandfather ran a mechanical engineering shop like for HVAC kind of stuff. And then my dad stumbled into owning his own company when he got laid off from like civil engineering work back in Houston. So he kind of had no other choice, started his own company, and ended up being the company that I ended up working for when I was of age to start working. So uh, we've all kind of stumbled into it, and it's not necessarily been a something that we are born to do, but it's just it just we all kind of find our way into being an entrepreneur, and maybe it's part of the genes, but it's been fun to kind of work for yourself, have some flexibility, some freedom, and kind of learn how to run a business.
Yeah. Well, you left your job in such a difficult time when we look back, right? Things were going awesome. So you bought your first one in 20, I believe,
Yes.
right? And we
21. Yeah.
21. We closed that first one. I can't remember if you closed the first one or the second one with
Yeah,
you.
you closed the first one with me late 21, and my first passive was just a couple of years before that. And so it was a very different world back in 2018, 2019,
Yeah.
2020. 21 hit, things started to, I guess 21 was kind of the same as before. Then 22 hit, and it was a whole new world. Um, and so yeah, it was interesting to kind of go through from seeing what it was kind of you know pre rate hike world, and then I bought ended up buying 2 more properties at the time when those rate hikes were changing, and so kind of buying in those churning waters and trying to figure out what's a good deal, how to look at the future as what to possibly underwrite the future, because it's not going to be like it was in the past, but we don't know what it's going to be in the future. So putting that all together was interesting, and now again, like you said, going full time doing this seems like a strange time to go quit your job and get into an industry that is changing, and is a probably, I don't know, maybe it was a bad timing, who knows, but we'll only know until when everything starts settling out. But I think it was a good move. I really enjoy the real estate much more than I do the computer tech kind of stuff. But so yeah, I decided I needed to make the leap, focus on my properties, and grow from there. So yeah, I had a full time W-2. and I was lead asset manager on 3 properties. Um, so that was taking up quite a bit of time. Not only that, but then the 2 little kids, and then maybe have a little time for family and friends. So it was quite a juggling act to kind of get through all that. A lot of late nights and Zoom at 8 sessions, trying to meet more investors and partners and vendors and all that. So it was a
It's
crazy
quite
time. Still kind of
quite
is.
quite remarkable to be able to go from a passive investing to lead GP. You found the deal. Now, let me back up a second. You buy in San Antonio and you live in San Antonio. How cool is that? Not everybody gets to live where they buy. So you're pretty special in that way. How has
Yeah,
that been for you?
I think if you can't do that, it really it's certainly possible, and people do it all the time. But I think there's a special ability to be able to, drive 15 minutes and go walk a property. You have a lot more knowledge, I think, of the area because you're driving it every day. You kind of know the spots around town, and you can get to know a city or a metroplex or something like that, some type of market, through the internet or through partners maybe. But there's nothing like truly understanding what the market is by living there and living there for 17, 18 years now. So I think it is important to live where you're investing, or have somebody that you trust wholeheartedly, maybe a property manager, but hopefully a partner of some sort in that, to try to really get to know that submarket.
Yeah, absolutely. So you started out, you joined a mentor program, apartment educators. So tell us a little bit about that journey. How did you find them? What was the time frame that you joined, you learned, you underwrote, you got your first deal?
Sure. So this was a kind of an interesting situation. I was going to a local meetup, and I'd heard from actually a friend of my wife, working at a tech company down here, was starting this meetup or doing this meetup, and it was probably 11 guys in a room just kind of talking about multifamily, and a couple of them had actually done it, but most were trying to learn the ropes and figure it all out. I figured out pretty quickly that single family wasn't gonna let me retire from my W-2. Like, I can do that, but that wasn't my game. So I wanted to level up to multifamily, and not only that, but bigger multifamily. And this group was a group of guys kind of doing it. And being in the right room is super important to doing anything you want to do well, right? So when I found this group, I knew that this was the right room to be in, and I started asking them, where do we get kind of more structured education and that type of thing. They recommended a couple of kind of coaching programs, but then when I was about to do one, and bite the bullet and jump into one, they said, "Can you hold off for like 2 weeks? We're actually starting our own." And so I was one of the first group of students to go through the apartment educators program. And since then, that was I guess 4 years ago now. And so that was a big moment in my life, to be able to you're not just kind of talking about it in a meetup with a couple of people. Now it's, how do you really structure this, and kind of build that networking. One of the big things that I saw was, okay, there's a big price tag on these programs a lot of
Yeah,
times, right? So sometimes they're 5 figures to join some of these programs, and it can kind of be daunting to say, is this worth it? Especially since a lot of the education, you can go to the library and get a book, or go to Amazon and buy a $20 book,
sure.
listen to podcasts all day long, and that's all true. You can get the content from other sources. There's no question about that. The thing that these programs do, not just apartment educators, but other good programs out there, they help you focus exactly on what you need to be focusing on. So when you're a solopreneur out there just trying to get started, there's a million things you can be looking at, and helping you focus on exactly what you need to be focusing on is important. But The other big thing is now you're kind of paying the entry fee into the club that you want to be in, right? So everybody in that club has already paid that entrance fee, and you know that they're serious, right? They're not tire kickers. You know that they're really gonna, be, good partners. They're committed to doing this, and that might be the most important thing about these type of programs, especially the more expensive ones, is the fact that you're getting a higher caliber of peer in that group. If it's a free education group or a cheaper education, that's not bad, but just know that the other people might not necessarily be as committed. You might have to find sort through people in those programs to find the people that are really committed.
So, I mean, great input on that. What amazes me is that you got into this education program. I mean, and very quickly you got a deal. I mean,
Yes,
that was amazing to me. Um, the question I have is, how did you put it all together? How did you find your sponsor? How did you find the money? Did you have a bunch of money? Kind of walk us through that because I think the people in the rooms think that you can't do this without any money. You could do it without any money. Okay. So kind of walk us through your experience.
sure. Yeah, this is, real estate's the best, get rich quick, slow, or get rich slow scheme that you can imagine, right? So it's a great way to do this, but this is not a no money down, seminar type thing. You do, in my opinion, need some seed capital. Um, and that usually comes, yeah, excuse me, from yourself, where you may have had some savings that you're ready to invest in that. And that seed capital doesn't need to be a direct investment always into a deal. You can learn a lot. And I think there is importance to that, but you use your seed capital for a lot of other things like education courses or putting money down for earnest money. That's a big one that can be a quick turnaround. Sometimes it's 30, 60, 45 days kind of a turnaround where you're putting up, I don't know, could be two, $300,000, but you're getting that back and then building equity with that short-term loan, kind of to yourself, and helps you get past that finish line. Always look at, other people's time, other people's money, other people's experience, all the OP, acronyms you can think of, and build that network. One of the things that I learned is, have a list of all the slots that you need to fill through networking and be purposeful in that. You need a great loan broker, you need a great insurance broker, you need, great property management, you need attorneys, you need all these different vendors, and then talk about the partners. When you get these loans that Julie can give you quotes on, uh, you know, they're 10, $15 million loans sometimes, or more, obviously. But let's just talk about a $15 million loan. Well, you need somebody that's signing on the loan that's worth $15 million, right? I didn't have that going into this, and I still couldn't sign on myself on a note for 15 million. That's okay. That's where everybody starts, right? So you find somebody else who is worth $15 million through networking and that type of thing, and they go by a bunch of different names, sponsors, or key principals or guarantors, whatever you want to call them. But those people are important, and they know this world that they can sign on a note and get some equity. Find those people. They're out there. Uh, but also capital. Obviously, that's a huge part of what we do is finding money to invest, right? And so that capital can either come from yourself if you happen to be independently wealthy, that's great, or your friends and family that may invest with you, or other passive investors. But a lot of times, even that network's not big enough to take down your first deal or be the sponsor in your first deal. So that way, or in that case, then you can partner with people, bring them in as partners onto the deal, and kind of share equity with them. And part of what they bring is their investor base to invest in the deal that you're kind of leading up. And that's really how I built my business, and I built the initial investments that I went through. As I partnered with people that brought in capital, to help me do that. So I'm very partner intensive in my business. I'm a single person business, but we have over $10 million of investments, three properties, 368 units, and the only way to do that is with great partners and then great vendors to be able to do those transactions as well.
Yeah. Well, I mean, you jumped in again, everybody, full-time parent and entrepreneur and W-2, all capital raising, building his business. I mean, so amazing to me. Um, so you've got one under your belt, you found another one, you found another one. We put bridge on your deal, on one of your deals. Kind of walk us through what you're finding today using Bridge. What are you finding on rents? What are you finding on some of your expenses? How are you seeing the next year or so for your transaction? Kind of walk us through that.
Yeah, so it's for those that don't know, bridge debt is intended to take an asset that's maybe underperforming or under market to some degree, and stabilize it and bring it up to as stable of a property, best investment that it can be, and then refinance it into longer term, what we call agency debt, with that's government backed debt, right? In the interim, government's not going to back a property that's underperforming or maybe needs some renovation or some capital improvements. And that's what we're doing here. So, yeah, we got into bridge debt, which tends to be 3, maybe 5 year type of a business plan. You do a quick ramp up to build, to grow the value, then you refinance into agency debt or sell it, right? And so that was, when you have a high growth in rent, or high rent growth, high value growth, growth of value in properties, that type of thing, you can add a lot of value quickly by doing these renovations. Well, when that business plan is still possible, you can still add value. It's not going quite as quickly as it did, 3 years ago. Um, and so what do you do in that situation when your business plan was built around, quick, kind of investment or capital investment growth? Well, what we're doing, is essentially kind of making it work, right? So we're finding where that best investment is, that those capital improvements, and injecting that where we can, but it's not just open the tap and go nuts. We have to be a lot more
Yeah.
strategic about when and how much of the property we renovate. Expenses are quite a bit higher than they were going into a lot of these investments, and we did underwrite expenses growth, but nobody's going to expect a 40 or 50% increase on insurance year on year. But sometimes we're seeing that. Not every time, but not every year, but one of the years, probably, if you've held onto anything in the last 3 years, one of those years, you've had a huge bump. And that's just because the market's correcting. The insurance market is going through some changes. So that's not uncommon for this type of investment. So what do you do is kind of hold on. Investment isn't a guaranteed annuity type thing. There is risk in these type of investments. So there's not only risk in the money that you invest in, but the time period that you might be doing it in. So those investments that we might have said, hey, it's a 3 to 5 year investment. Maybe we have to extend it out to get to
Absolutely.
the returns that we're expecting. And we do expect the market to correct, and I mean, just like every cycle that's happened before us, it's going to, and our values are going to go back up. Now it's a matter of, can we survive till that to that point in time? And there's a saying that was going around: survive to 25.
Yeah.
And that just means, we're not going to grow massively between 2023 and 2025. But if we can be one of those that survive and don't go into default with some of these debt packages, then or default, excuse me, into some of these debt packages, then I think the other side of this wave is going to be phenomenal. And so, yeah.
So you're still underwriting deals, right? What are you finding in San Antonio? And by the way, maybe you can give us an overview of where people should be looking in San Antonio. We've looked the northwest side. We like that. I've seen stuff on the southwest side. Where do you think the opportunities are in San Antonio? Where are you going to get your best resident in San
Sure.
Antonio? What is your thoughts?
Think I mean the med center is always a strong candidate. It's got really strong uh, rent growth there and really good tenants. And there's it's kind of in town a little bit more, so there's not as much development that's possible in town. So right now, the further out you go, the more competition you're going to see with new development going in, and a lot of the new development that we're seeing, kind of the north and north west side of town, some of the northeast side of town, they're just coming online from property or projects that started 2.5, 3 years ago, right? So they were expecting all this great stuff. Well, now they're in lease up in a time when leasing isn't great. So they're offering 2, sometimes 3 months free. And
Yeah.
so even if their rents are much higher when you average it out through the year, sometimes they're right on par with the class C properties,
Yes.
like C plus properties. So they are your competition. And you're competing with the 1985 property with a 2023 or 2024 new development. That's tough, right? So when you're talking about San Antonio, really any metropolitan area, even if you're looking at Class C, look at that. Especially right now, is what are the deals, what are the specials that these new developments are
Yeah.
offering for their lease up.
Yeah, absolutely. We have seen a lot of impact from those new developments on rent growth for sure.
Now, in
What
2 years, we're not going to have that much worry because nobody's starting any
correct?
new projects. So
Yeah.
those are all going to be saturated and already absorbed into the market. So really, now's a pretty good time to start thinking about getting into multifamily if you haven't yet. Deals are a lot better when they come out. If the transaction works and the price is right, then you're getting in at a pretty good basis. Where in probably 18 months, these things are going to be worth much more. It's just a matter of trying to find a seller and a buyer that want to transact.
So you have three assets in San Antonio, and that is marvelous. I gotta tell you, because you're able to buy and run your property management pretty tight. Now, do you have the same property management on all three, or have you divided them up? There's a couple different philosophies. We don't want to give them all. If we don't like them, we've got some ability to change. What are you doing?
I was with two different property managers for a while, and in kind of summer of last year, I decided to consolidate. So it was nice to see the differences because again, I'm relatively or was relatively new to asset management, so I didn't know what I didn't know about property management. So getting to see different, the way that two different property managers work and talking with other people and seeing what other property managers are doing and getting recommendations throughout the whole lifespan of my real estate career of what good property managers are in town because that's obviously important. You want to make sure that they know your market, right? Um, then so I ended up consolidating kind of summer
Okay.
of last year. So we've been with the same company for all three properties now, and that has some definite advantages. I agree there could be some reasons to kind of split them up, especially if they're different business plans or different asset classes type thing. If there's a class A property and then a class C property in your portfolio, one property manager might not be the expert on both ends of that spectrum. So get the right, team for the job, I think.
So when it comes to brokers, and I'm talking about your sales, investment sales folks. So you got the first one. They might not have taken you too serious. Over the second and third, have you found that they treat you differently? Are they now taking you out for dinner or lunch, or are they now bringing you real good opportunities? What has transpired over the time, 1 to 3, and now, obviously other opportunities? What are you finding on the sales side?
I think I don't know because the world's changed so much between now and
Sure.
then too, from my first deal to this one. So
Hmm.
what given everything being equal, would it have been the same situation? Because everything was going gangbusters before. Now these
Yeah.
deals are, true deals are fewer and far between in
Yeah.
some ways, because there's so much less volume, but there's still a lot of people who still are professional investors and they want to transact. So they might, other bigger firms might get first looks in some of these deals, but they might not understand the value because they may not live here or something like that, right? So I think I'm still seeing good deals and I'm underwriting, a
Okay.
fair amount still. I think in general, even people that are seeing good deals are still their volume is much lower.
Yeah.
Or people that have huge portfolios, I think are still seeing a lot, fewer deals that make sense that come through. So they might be underwriting stuff, but I think we're all seeing pretty similar,
So,
properties.
yeah. So when it comes to underwriting, what are you underwriting rent growth right now? And are you marrying those up for the first year on expenses as well, expense growth being about in line with each other? How are you managing that? How do
Uh,
you
for
look
the
at that?
past, yeah, for the past couple of years, I've actually had expense growth higher than rent growth.
Hmm.
And I think honestly that's what we have seen in reality. So I've backed off a little bit on expense growth recently. In the past, it's been about 5%. Now I'm backing off to about 4% year on year.
Okay.
Um, and rent growth is usually under that. I
Okay.
do expect it to go up at the end of a 5 year business cycle, but not by too terribly much. So it's we're seeing pretty moderate rent growth, and I think we need to look at that. I mean, really, we're seeing almost zero rent growth
Yeah.
right now, but I think that's you can be terribly conservative in every underwriting aspect that you do. Uh, and yeah, your deal would be super safe if you were ever able to buy anything, So
Sure.
there has to be some concessions to conservative underwriting, but they need to be, strategic and have something backing them. So
Yeah.
rent growth, I think the data shows that rent growth is going to return back to where we were seeing rent growth. Maybe not, a few years ago of 10-15% sometimes of rent growth, but we might, go back to seeing 2, 3, 4, maybe 5% rent growth in the next, 3 or 4 or 5 years.
Where are you seeing caps right now in San Antonio?
Kind of funny. I don't look at cap rates
Hmm.
as much as maybe super institutional investors.
Sure.
The deals I look at, they have so much hair on them for the most part that it's you kind of got to stabilize the everything and make it apples to apples comparison to make
Yeah.
those cap rates mean anything. So
Yeah.
I mean you're seeing 6% cap rates, maybe 6.25, 6.5
Okay.
for some things, but between 6 and 6.5 I
Yeah.
think is what we're seeing out there.
Yeah.
But usually I still have to run all the numbers and see if the return to my investor, which is the end all metric that I'm looking for,
Sure.
um, can make sense and I can support that.
Well, and there's the problem, because when we've got cap rates that are at 6.5, and we're underwriting on the debt side that's at 675, 750 with a step down approach, we get into negative leverage, folks. And that's what we want to stay away from, right? So a lot of these deals do not make sense. A lot of them are pushing towards a cap rate that doesn't even exist. It's not a five. It's not. A lot of these deals are in the sixes, and that's rightfully so. We've had so many years of compression that we need to, there's going to be a distinct difference between the A's, the B's, and C's, and we're going to get back to business as we knew it. Now, Kenneth, do you have any pictures? I don't know if you were able to put together anything so we can show the audience where you were and where you are today. Any on your
Oh,
assets, your before and after?
no, I don't have any before and after. Sorry.
Okay.
I if you check out my Instagram, I think there's some older pictures of some before and after stuff on there. But
Yeah.
yeah, no, I wasn't able to get that
No,
together.
no worries, no worries. So you are now working with the educators. You're a coach, which is fantastic. Um, what are some of the challenges that you're seeing or that you're communicating with your students
Sure.
about the market we're in and what you've experienced so that they don't? What are those challenges?
I think patience is a big key right
Mm,
now. Is understanding that when I was first getting into this, I had in the first probably I don't know 11 12 months I underwrote probably 150 deals, and a lot of them made sense, and I put a lot of offers on the table. Well, that's not happening right now. You might underwrite 40 deals, and one makes sense. So that's okay. And just that repetition is still important. You still need to underwrite and learn how the underwriting works, and just know that it's not uncommon right now to not find a lot that does actually pencil, and makes sense to put an offer on. But going through the motion, going through the cycles, and the reps is still important. Capital is also a thing that
yeah,
is a little bit tougher now. Back in say 2020, um, capital was a little bit easier to come by. It was easier to raise money, and some
falling
people
out of
that
the
were
sky.
raising. Oh yeah, it was falling. I mean, people were throwing money at you to
Yeah,
get into these deals. And now that it's kind of funny. The deals are probably better right now, in terms of the potential upside, because you're buying at such a good basis. The money's not just throwing itself at you right now. So
yeah,
be patient in that too, and just
love it.
you know focus on fundamentals of underwriting if that's your game. If you want to be a an excuse me, on the acquisition side, focus on underwriting and get that tuned in and understanding where all the inputs and outputs are. If you're capital raise centric and kind of investor relations centric, um, still just put in the time, put in the effort, build your network, put in the fundamentals. Then when things do start taking off again, you don't have to relearn all that stuff. You already have a pipeline, you already have a method to build your investor network. And you already have maybe some track record in terms of a newsletter or something that you've been putting out every month, whatever it might be. Build that track record, put in the reps, and that's I think that's my advice to
I
most of my
love it.
students.
I love it. Now, for those people that are new here and they're now you quit your job, so now you have 40 hours. Okay. You used to have 80 hours you were probably doing this. Now you've cobbled back 40 hours. What does it look like for you in time wise on a weekly basis? How much time do you invest in these assets, driving there, running the KPIs, talking to property managers, getting on site, talking to the residents, the maintenance guys? Walk us through that. How much time do you spend? What's realistic?
Well, what's kind of interesting is I built my business on efficiency, right? I hired good vendors. I partnered with good partners to where, I knew that I wasn't going to be able to spend a full time amount of time, on the property site and build, doing all these things. So I built my business pretty efficiently to where it could run on kind of a few hours a week or handful of hours a week. um, Now so now that I have more time, I do kind of deep dive more than I may have been able to before, or at least now I get to do it during working hours instead of at night. But so it's hard to estimate that, because an entrepreneur kind of tends to have to do some reactionary situations where there may be a problem to solve. And when does that take place? If it's the middle of the day on Wednesday, or is it or is it Thursday night or the weekend? So how much time do you commit to that is tough to say, because some weeks it's a lot of work. There's a lot to do. And I might be, in the office for a full 40 hours for that week, putting in time, especially with like insurance renewals or tax season, that type of thing. There's a lot going on. Then there's other weeks that, I mean, it feels like I didn't do anything that week.
Mm-hmm.
Where I try to make, kind of intermediate goals and make sure that I am, moving the needle. But maybe I do a deeper dive on the trending of where the expenses are going, and I dive into that a little bit more with my property managers. But I've hired really good property managers, and they already kind of see a lot of this and where it's going, and I ask questions and make sure we're on the right path. But they know what they're doing, and I do trust them. So that helps
Very important.
alleviate some of my time.
Yeah, that's great. I mean, I think a lot of people think, oh, it's just going to run itself and I can go on to the next asset. And I don't think you really need to unpack that with real people that are doing the business. Okay. And I think that's exactly what you unpacked for us. So, what's on the horizon for you, Kenneth? What do you see in the next year for you, 5 years, 10 years in multifamily? Where do you see yourself?
Yeah, I mean, I still I want to get back to a better pace of one, two, three properties a year, something like that, to acquire, build a bit of a team, raise more money. So I think it's kind of, I'm not trying to necessarily 10x where I'm going right now, where I know that's sometimes one of those audacious goals. You're like, let's 10x whatever
Yeah.
you're doing. I think maybe trying to 50% or double what you're doing is still a valid goal in this time frame, and just helping other people make I love seeing people go from 0 to 1. That's a cool transaction or transition,
Yeah.
and seeing people say, hey, I'm actually a professional investor, and they might raise money for a deal. That's pretty cool to me. So I think focusing on that area of the coaching and education part, and bringing the right partners together. But yeah, let's
Yeah.
I just want to kind of take it a little bit step by step, and just buy good real estate.
Yeah, your growth has been amazing. If somebody wanted to get a hold of you, and you are a sponsor, I just want everybody to know that. So if you're looking for a deal in San Antonio, although you'll look at other markets, I would think, or not, Kenneth?
I will. I know San Antonio well, so I've been
Yeah.
asked on other markets, especially even in Texas, and I'm kind of I can recommend other people, but I don't necessarily know that well enough to, I think, add enough value. But if depending on my role in the project, I'd be willing to go outside of San Antonio, but really a lot of my expertise is here.
Yeah. So everybody, think about this. Kenneth has left his job. He does multifamily full time. He's a sponsor on your deal. You have to keep your eyes on that asset. He has signed his life away on your deal. So you have to take very good care of Kenneth as a sponsor and the deal that you're managing. Because if he gets cut off from his lender, he can no longer go and buy other assets. So it's really very, very important when you ask a sponsor to jump into a deal, to sign on the loan, that you have a responsibility to that sponsor to do a good job, because you do not want to cut his lifeline off to lending opportunities, okay, or being able to buy opportunities. So great. Kenneth, if someone wants to connect with you, coaching, find out more about what you're doing there, how would they do that?
Yeah, I'll put my contact information in the chat. I mean, I'm a little old school. Email's still great, but I have my phone number on the deal. But also, click on my Calendly link, book some time with me. I really enjoy talking real estate. So, if you're interested in learning a little bit more about what I do and how we may be able to partner, or if you're raising capital and they're looking for opportunities, hit me up. We're always gotten something in the works, and I think we can make something happen. So I'll put that in the chat right now.
Awesome. Awesome. All right, let's open it up real quick for questions. I know that there were some in there, but if you guys have a question you didn't post, raise your hand and we can reach out to you. Let's see what we got here. Let's see. What markets are you seeing a 40% increase on insurance?
A lot of Texas. JP or JT can probably speak to some of those. Houston is abominable. I mean,
Yeah.
they've seen in a 2 year time frame sometimes 100% difference, gone from like 1,000 a door to 2,000 a door sometimes. I'm not in Houston, but that's a tough market. The coastline in general is real tough. So I mean, again, I'm in Texas, so I'm looking at Corpus Christi, that type of thing. And I've looked in those markets, and I can't make it work right now, and the prices haven't quite adjusted enough for me to be able to pay that expense, because the rents aren't really supporting that. San Antonio's not been as bad as Houston, but it's still growing considerably, and it's not just because of the necessarily that the there's additional risk or anything like that. There was some kind of systemic changes that happened in insurance in the last really year and a half, 2 years, about rebuild costs, and get with your insurance broker. I guess I won't go into the whole diatribe about it, but um, it's generally increasing, and then that was also compounded with with the expenses going up quite a bit, and contractor cost and all that. So it was just a kind of a series of unfortunate events that some of my properties, yeah, I've seen 40, 50, or 60% increases year on year for 1 year. Now the next year it might be 5 or 10% difference. It's not going to be 40% for 3 years in a row, hopefully, but it's still one of those years recently. Is I can guarantee you've taken a hit if you've owned assets in a market, especially in Texas.
Yeah. All right. Anybody have questions? We've got the industry expert here. All right, JR, what do you got?
Hi, Kenneth. JR here. So I've been underwriting a few properties in SA, especially the one right next to oh man, what's that bank now? I'm blanked out. It's the military bank, USAA,
Okay.
and it was a converted hotel at one point. And when I got the CoStar report and everything that has to do with that particular property, it was showing that most of the property in Houston are seeing a -3% and more in rents. Is that just in B and C properties, or is that also tailored to A properties?
I guess that's like a CoStar report of some sort, or some type of
Yes.
industry report. Those are kind of funny. Take those with a grain of salt. I don't think we're seeing 3% negative rent growth. That's not what I'm feeling, or the operators that I'm connected with. I don't think it's negative. I don't think it's growing. I think you're so maybe on average. Even that I don't agree with. So I don't necessarily know where all they're getting their data, and sometimes CoStar data can be a little finicky. A lot of times I'll have a comp of one of my properties when I'm buying a different one, and I'm seeing the rents on those are wrong, just straight out. So
Interesting.
data is only as good as it's kind of garbage in, garbage out. So I don't see that. I still think talk to your property manager. Read your reports, and that's important. Maybe you can glean something in general. Talk with a local property manager and see what they're seeing in the market in real time. That's going to be much more accurate.
Yeah, a great
Got it.
suggestion. I really like that. All right. Anyone, last call for a question. Sanjay, Mohan, Rebecca, Deepak, Vlad, you Ben. All right. Well, It is so great to have you here, Kenneth. You've come and gone, and it's just great to see your success and being able to share that now, nearly 3.5, 4 years later. It's terrific. So, congratulations on all your success. Thank you for your business. We've done 2 loans with you. We're looking forward to doing the next one and helping grow your business and being successful. So, thank you for being here. Appreciate it.
Thank you for having me. I appreciate it, Julie.